Hello, everyone. My name is Sarwar Qureshi. I'm very happy to be joining you. I live in Ottawa. I've worked with Carfax before and some other organizations, and that's how I connected with Heather and Marie Helen. And my role, the work that I do is I'm a CPA, a chartered professional accountant, and I work with small business owners, mainly for things like tax, financial statement, and other related advisory. For most people, taxes is a complicated thing. CRA is a bit of a stranger danger. There's a lot of concerns that people have when it comes to things like tax, accounting, and what they don't know. So we're just trying to give people education, information, make their life as easy as possible. Most of the people we work with, they're very good at what they do, which might be music, it might be art, it might be food, it might be construction. And of course, the accounting and tax can sometimes be a bit of uh, an area that's a little bit unknown. So we try to make that as easy as possible, get the right people and the right team in place to look after everything. And the session today is really to give the people in the artist space some background information when it comes to record keeping and bookkeeping, some best practices, some tips and things that they can be doing to help them be aware of what some of their obligations are, as well as to be aware in what areas they can do things themselves, and maybe what areas it might be a good idea to get some help. Because, like many things, there are some things that are better left to the experts. If my car has an issue, if it's minor, like the tires need to be filled up with air, I could probably do that. But if, the I don't know, the transmission needs to be changed, I'm probably going to need to go to a mechanic and get the right person with the right tools and the right expertise to look at that. So depending upon what the issue is, there are certain things when it comes to accounting and bookkeeping that people can do themselves. And by all means, we want to share that education with you. And some things that if you get into those levels of complexity, you might need and should consider getting the right experts. So we want to kind of lay out where that cutoff is and what those scenarios can be. So on that note, we'll dive right in. And basically, if, as Heather and Marie Helen mentioned, if there are things that people want to add to the chat, we can kind of keep an eye on the chat to see if there's things that people want to cover. And in addition, at the end of the hour, there'll be a 30-minute Q&A that's planned. So we can try to make sure we take questions as we go, and some of the content might cover what those questions are asking, so we can defer those questions until the content covers them. And of course, at the end, there'll be an opportunity for Q&A if there are additional questions or things that weren't covered. So we want to make sure no one leaves with any question unanswered for the most part. So if someone has started a business or is thinking about starting a business, the record keeping, the bookkeeping piece is very important, because when it comes time to things like filing your taxes, things like doing your financial statements, things like, talking to the bank about getting a loan, these documents will come in handy, and the more organized you are, the easier it is. So sometimes, I joke with people that in the old days, when I started working in accounting 15, 20 years ago, it would be receipts that would be stuffed in your, glove compartment of your car, or in a shoebox, or some other, folder file system that people had, and all the receipts would kind of be overflowing until the end of the year, until such time that someone would, hopefully organize them or look at them and whatnot. We've, I think evolved and have now reached a point where there's a lot of paperless options. So it isn't that, idea in our heads that it has to be a giant blob of papers. Now we have a lot of tools and technology. Some of the businesses that I visit, they don't even give receipts anymore. I think I was having lunch today, and at the time of using the credit card to make the payment, four options I think came up on the screen, and one was, text the receipt. Then there was print the receipt, email the receipt, and no receipt. So I could choose from the four options, and I chose email the receipt, and that was for me the best option. Go straight to my email, and then I can kind of, tuck it away or file it away in my system, and I'm not really dealing with any papers at all. So we've reached this kind of interesting stage now where there is a lot of paperless options. Not to say it's entirely paperless, because some, businesses and vendors still give receipts the old-fashioned way, but all that to say, we'll kind of give some tips on best practices on what to do when that happens. And now, people have systems that could be partially paper-based, partially paperless, maybe entirely paperless. That's, for some people a goal. And the first question, or the first thing that some of you might be wondering is, are electronic receipts acceptable from the government's perspective? And the answer is yes. The electronic receipts are acceptable. So if someone offers you an electronic receipt, there's no problem with that, because now, as I mentioned in my example with the restaurant, or some of the other businesses that I see who use email to send invoices, to send payment requests and things like that, everything is done electronically. So there's no concern for you as the business owner, for you as a person doing the record keeping, that I did not get a receipt, or, oh, I'm only getting this electronically. It is acceptable. It has to be complete, because sometimes what happens is, if you get a paper-based receipt, you try to scan or take a picture of it, it gets, cut off or blurry, or something gets missed. That, of course, might lead to missing information. But as long as it's a complete scan, a complete picture, and it's clear, not blurry, then it's fine. So we want people to feel comfortable if they prefer using those online tools, using, there's a few apps out there, there's a few different programs out there. You can scan receipts, you can take pictures with your phone, you can use an accounting software, which we'll talk about as well later on. Then you can move into this paper-based, or sorry, paperless world and feel comfortable. The other thing that's worth mentioning that's very, very important is, when it comes to receipts, when it comes to contracts, invoices, agreements, estimates, all these different things that you might have, there is no rule of thumb of what you should and shouldn't keep. What I usually tell people is, keep everything. That way, we're not missing something. Sometimes people think like, oh, I don't need this, or, oh, I don't need that. You don't know, unfortunately, if you need something until oftentimes it's too late. And what I mean by that is, the way that the tax system works in Canada is, it's kind of like the honor system. And what I mean by that is, you get to file your taxes and put anything you want on your taxes. So I'll use an example that's not even related to business. If anyone here has donated to a charity before, there's a lot of great charities out there doing a lot of great work, you will get usually you will get a charity receipt, a donation slip. So it's an official document. It contains all kinds of useful information on it, verifying that this is a legitimate charity, and they have a identification code that they're supposed to put on that receipt, and all of that stuff about you, and who you are, the donor, and the amount you donated. But let me give you an example. When it comes time to filing your tax return, you could put any number that you like for the donations that you made during the year. You could put 1,000, 10,000, 50,000, 100,000, any number that you want. Whether or not you actually donated that amount, the tax return isn't worried about your receipts at the time of filing the tax return. So if you've tried to file your own tax return, or you've had an accountant help you with the tax return, they just want a number. The receipt is sometimes something they want to have as well, if you're working with an accountant, but for the purposes of just filing your tax return, you just need to put a number in the box. So what happens is, the honor-based system means the government receives your tax return. The government can do a couple of different things with it. They can process it and say, thank you very much, you've submitted your tax return. Here's your notice of assessment, NOA for short. And that means, we've processed it. So you're good for now. We'll let you know if we need anything further. And they can ask questions after that. They have the right to. Or another scenario is they might say, we've received your tax return. Before we process it, we would like to ask you a couple questions. So usually you get a letter in the mail. The letter in the mail might say, on your donation section, you claim donations of $10,000. We would like to receive some additional information about that before we proceed. So then, you have to package up your receipts and send it off to them. So the honor-based system is kind of applicable in the first scenario because the vast majority of people, when they file their tax returns, it'll get assessed automatically. The government doesn't have the resources to actually conduct a review prior to processing the tax returns for all Canadians. There's just so many Canadians out there, and there's a limited amount of resources. So the vast majority of people, you might have likely had this before. You file your taxes, you get a notice of assessment. That's it, kind of wipe your hands of it, or don't worry about it, on to the next thing or on to next year. The other group is a small percentage or smaller percentage, once in a while, depending upon what the amount is being claimed or what is being reviewed, what stands out in their system, people will get picked up or flagged for that information request. So in theory, people could claim amounts that don't actually correspond to receipts and still have their taxes being processed. So that's what I mean by the honor-based system. Now, I'm not suggesting anyone would do that or anyone should do that, because that is obviously going to create a different set of problems. But the receipts, when it comes to donations or anything in your business, are all expected to be held and verifiable after the fact, should the government ask for it. So it's not a matter of you claim an amount and don't have receipts for it, because if they ask, you're going to have a problem. And in the first scenario that I mentioned, that someone files the tax return, it gets processed and assessed without any questions, the government still has up to 7 years, and that's a long period of time. 7 years is a long time. If anyone here is like, 20 years old, that's like a third of your life, or more than a third of your life. So by all means, you need to keep this information and not just get rid of it at the time of filing the taxes or at the time of receiving your assessment. You need to hang on to it, because the government can, years after the fact, come back and request it. That, for a lot of people, is a wake-up call or something to be aware of, so they have the right system in place such that they're able to meet that requirement. They're not, 3, 4, 5 years after the fact of filing their tax return, receiving a request and now worried, oh, what did I do with that receipt, or where did I put those documents? They have a system, maybe it's electronic, maybe it's paper-based, and they can access that information fairly easily. That's the very, very important thing. So I see a couple questions in the chat. Is it 7 years? So yes, it is. So that's the first comment. Someone mentioned 10 years. So it's 7 as far as I know, but I will add to that. If I'm trying to phrase it in the right way. So if they ask you for information and you're not able to provide them information in a, we'll say, reasonable fashion, and they have reason to believe that things were embellished or made up, they can go back even further. So if I go back to my donation example, let's say someone has no donation receipts at all, didn't make any donations, they don't donate to any charity, but in order to get the credit, they would, on their tax return, claim an amount for donations, and after a few years the government reviews their tax return, asks for the donation receipts, they have no receipts whatsoever. The government can now say, hey, hold on a second, you claim donation amounts, you don't have any donation receipts, we have a reason to suspect you for other years that you might have done the same thing, right? Because you might be doing this on an ongoing basis, hoping you never get caught. So then they can kind of open it up on a more massive level. So if someone does get a review from CRA, that's, not the sole focus of today's chat, so I'm not trying to go into it too far in detail, but normally what happens is either someone will have all the information they require and they will say, thank you very much, and that's it, or They will have some of the information they require, in which case they will say, okay, you have some receipts, not all. And depending upon the person you're dealing with, they might say, that's fine. We believe you. You might have lost one, or you might have been missing one, or whatever the case is, but you have most of them. That's fine. Or they might say, hey, you don't have enough for what we think is reasonable. We're going to do a more far-reaching look, either at other items on the tax return or other years, like the donation example, going back even further. So it can go back even further if they think you've embellished or, outright lied about something. But 7 is the typical, as long as you're doing things properly, they don't have any reason to believe that you've made up something. They would not go back any further than that. So some people, they have a system where as time goes on, the old stuff kind of falls off the 7-year cutoff, and then they can kind of, take that information off as time goes on. So in anything that you're reporting, that's the first thing. So if you're starting a business or you've already started your business, record keeping is very important. And I mentioned earlier, keeping track of all the information is very important. If you've been doing that, great. If you haven't been doing that, not the end of the world, in the sense that if CRA hasn't asked for any information yet, it's not a problem, right? The problem only occurs if they ask. So for a lot of people, when I talk to them, they don't, if they didn't know about the 7-year rule, what I tell them is, let's not panic, but let's just start to do things properly today, or whatever's reasonable, so that we're not in this situation of being unprepared forever, because obviously we want to make things better and lose that stress. So, sometimes I meet someone, they started their business 2 years ago. They didn't keep great track of their records, but obviously once we get working with them, we say, okay, let's make sure that's not a problem, to do things properly so that we're on the right track and we don't have that issue. So as I mentioned, invoices, receipts, contracts, estimates, there's other things that might be specific to the business that you run, but anything like that that pertains to your business that you plan to make a claim on your tax return. So, you plan to claim something as a deduction, you plan to claim something as an expense. I would say, yes, you would want to keep track of it. Any amounts that you're invoicing, you're sending an invoice to a customer to receive payment on, you're signing a contract with the customer, you're doing things like that. Once again, you would keep those documents. And then of course, bank statements, credit card statements, which add additional information, because you issue an invoice to someone, that's one document, then they actually pay you and it hits your bank account, that's another document. So sometimes CRA can be so picky that they want to see two forms of corroborating information. So for example, someone might say, I have this receipt, I bought a computer, here's my receipt. I've seen sometimes the auditor or CRA say, okay, you have a receipt for a computer, how do we know you bought that computer? Because if you get a receipt from the parking lot of Walmart or a computer store, you could just pick up a receipt, that they might have had lying around, that someone else used. So of course they will ask, if they feel suspicious. It's not a regular request I've seen, but once in a while they might say, okay, show us the proof of payment, which might mean your credit card statement or your bank statement, which shows that amount going to match the amount on the receipt. Because naturally, if you pay for something with a credit card, you have the receipt and then you have a credit card statement. If you pay for it with your debit card, same idea, you have your bank statement. So you should have, or could have, a second piece of information that corroborates any amount that you're claiming as either expense or income and whatnot. So it can be very, very onerous and tedious. And I'm maybe taking a approach which is kind of like worst case scenario to kind of get you a little, maybe frightened or worried about, okay, we got to make sure we're doing this properly. But in reality, I do want to mention that once you get a good system in place, it can be very smooth. It can be very easy. Like for instance, I mentioned today I went for lunch. I took the receipt by email. We have other systems in our office in place where if you get a receipt in paper, I don't have a receipt on my desk here. I have this is my kids coloring, but if I get a receipt from a store from the a printed version, there's apps that you can use that are on your phone. You can take a picture of the receipt, then you can discard the receipt, and the app will upload the receipt. So everything can be really, really seamless. And then you can have a system that you put in place where everything's kind of getting organized and sorted, and it's not requiring an enormous amount of effort. The the main thing is having a system that makes it kind of efficient and fluid. The days of like just accumulating mountains of receipts, I think, kind of give people an image in their head that's like, oh, I'm going to have like hours and hours and hours of paperwork to do at tax time, which for some people is the case, but it isn't necessarily the case if you want to be organized and have a system that's kind of doing things on an ongoing basis, which is what we recommend, every month, every week, every maybe 2 weeks, every few weeks, having a system where everything is just kind of kept up to date. And then that also allows you to kind of be comfortable with the record keeping being caught up, as well as having a good sense of how the business is doing. Because the benefit of good record keeping is you get a snapshot of the business revenues and expenses. So you can get a lot of useful information from that. So, we can kind of see when we work with some clients that have good systems that we can do an analysis to say like, yeah, it looks like you're having a good year and you're making a decent amount of money or you're reaching your goals versus someone else that you're not on track yet. Your business isn't where it should be. Maybe we need to make some tweaks. Maybe we need to cut some costs. Maybe we need to pick up some sales, and we can kind of make some strategies to help figure that out. If you have good record keeping, if all you have is a mountain of receipts, you can't really do much from an analysis analytical point of view because all the information isn't in a usable format. The data is kind of disorganized and not really usable. But if you have it in an accounting system, you can run one of the reports is called profit and loss. One of the reports is called income statement. And that report can kind of give you a snapshot of how your business is doing at any point in time. And you can, analyze that. So on that note, I think one of the questions or one of the comments in the chat is kind of thinking about where I want to head to. And that is just spending a little bit of time, because we're talking so much about record keeping, to talk about some of the programs and apps and things that are out there that you can look into, just to kind of give yourself the most technological tools that you might want to look into. So one thing that I will mention or say is any tool that I'm sharing is based upon tools I've seen clients use and have success with. So by all means, those tools could be good for you, but any tool needs to be researched, needs to be maybe considered and compared with the other tools, because there's a lot of competitors in the space. So if you have 3 or 4 different options out there, you have to see what option is best, because most of these tools are going to ask you to sign up and pay money. So I'm not suggesting, you sign up for all of them or you sign up for any one of them until you've spent time to figure out which tool is best for you, because each and every tool has its pros and cons and costs. So, there's certainly some challenges. So the first tool, which I think a lot of people may already have or may have access to, and I'm going to show you at the end of our session today a little bit about how we can use it, is Excel. Excel, and there's other versions of Excel, like Google has its Sheets, I think, and Apple has its version as well. It works quite well for certain record keeping purposes. You can use Excel if you have any experience with it. That you can set up formulas, you can set up different tabs, different worksheets. So Excel can work really well. And for the most part, in my experience, if someone knows how to use Excel and if the business doesn't have too much complexity and too much volume, Excel could be suitable. So what I mean by that is if your business has a few, maybe let's say 10, 15 transactions in a month, then Excel is kind of reasonable, because the main thing with Excel is you're doing data entry on a individual basis. So every time you have a transaction, you're entering it into Excel. So it takes time because you're doing manual data entry, that on this date I bought this, on this date I bought this, on this date I bought this. By all means, if there's not a lot of volume of activity, it's very, very reasonable. But if you're operating a business with a high volume of activity, it may not work well. So let me give you an example. If you have an artist that might sell one or two paintings a month, you know, there might not be a very high level of volume, and Excel could be perfect for them. That's going to be suitable for what they do or what they need. But then if you have someone operating a coffee shop and they have 40 to 60 customers a day, that's going to be way too much volume for someone to handle with Excel. They're going to have so many transactions, so much volume on a daily and monthly and ongoing basis that Excel would not be able to handle that. So really, Excel can kind of work well and be a low-cost option for some people at the beginning, or if they're in like a situation where it's a low volume, low activity business where there's just a couple of transactions, here and there, and it's kind of reasonable that someone does the data entry on an individual basis and doesn't mind spending that time to do it. It works perfectly. The benefit of jumping up to an accounting software, there's 3 or 4 main ones that I've seen people use. The benefit of that is accounting softwares, the online ones, have integration with the online banking. What I mean by that is your accounting software, you enter the banking information into it. So, let's say you bank with RBC or TD or whichever bank you bank with. Most banks have this compatibility with the accounting system. Then the accounting system can go and pull that data automatically and do some basic record keeping as a starting point, which you have to review and approve of when you do the full cycle accounting. But it gives you a lot of automation. So instead of going through each and every transaction individually or kind of dealing with it manually, it already knows in an accounting system that when you have, let's say, a credit card purchase from UPS, that this is going to be a shipping expense, because in your business, if you regularly have UPS purchases and you use them for shipping your products, you can set that up in the accounting system so that it knows when it sees UPS, it knows this is a purchase. Similarly, if you go out to have a coffee at the same coffee shop all the time, Tim Hortons, it knows, because you can set that up, that every time it sees Tim Hortons, it knows this is meals and entertainment. So it allows for a lot of automation, which can mean, things can be streamlined, things can be made efficient. So if that's your situation or you want to look into it, the main ones I've seen my clients use are QuickBooks Online. So I'll say that first, QuickBooks Online. Maybe I'll write them down in the chat. That way you can copy and paste them if you'd like. The other one is FreshBooks. And the third one is Wave Accounting. There's more than just these three. It's kind of like cars. There's tons of cars out there. I'm not going to give you every single type of car or every single type of accounting software out there. I'm just giving you some of what I think are the more popular ones that I've seen with my client base. They all have pros and cons, as I mentioned. There isn't one, and I don't work for any of them, so there isn't one that I recommend. Someone's asking if any of these three are Canadian. I don't know the answer to that, actually, so that might be something I have to look up, but maybe on their websites, I think they would mention it. I think one of them is from Australia, if I'm not mistaken. But in any case, I think they all have Canadian information because they understand how Canadian sales tax works. Obviously, Canadian sales tax in itself can be complicated and whatnot. and they have Canadian payroll information and payroll tax information. So they have customized their product for the Canadian market, and I'm pretty confident that they're in other markets as well. Like QuickBooks, I think, is American, and they have, their product kind of customized for the different markets they're in. Each of those three are competitors, and I think if you're ever interested in them, like any competitors, they have different pricing, they have different promotions, they have different sales. So sometimes you can jump in at a certain time of the year and see that, um one of the programs is on sale or has a discount or a special. I think some of those programs also have a free trial period. So if you're interested in, let's say, trying it before you commit to it, 30 days or 60 days, I think is a trial period that you can get with some of those softwares. So you sign up, and then, if you like it, keep it. If you don't like it, you cancel before the 30 days. I see a question about Square. So Square is a payment processing application. I, I don't use it myself, but I've seen customers and clients use it. But it's basically, depending upon how you set it up, it's something that you can integrate with your phone, and then you can accept people's credit card payments using Square. So I think the three accounting softwares all have Square plugins, or they have their payment processing plugins. So if someone wants to accept payment processing with the accounting software like Square, then they are able to. I also know QuickBooks. That's the one that my office uses, because that's the for our own internal accounting, we use QuickBooks. They actually have an option where, let's say I'm doing business with someone and I want to send them an invoice by email. And in the email that I send them with the invoice, they have the option to click a link to pay me. QuickBooks can do all of that integration in all in one spot. So, in theory, I could say, okay, I'm setting up, let's say Tim as a customer. This is his email address. This is his details. Set up the invoice, make sure, it has all the pertinent information that I want it to have. And then I can send Tim the invoice by email, or QuickBooks will do that for me. And then when Tim receives the email will have the invoice and will have a link to pay now. And many of you may have seen that, because you might have customers, or vendors, I should say, not customers, vendors that send you invoices that way. I think I have a snowplow uh, contract for our house, and that's how they send us their invoice. They send it to us by email. You click the link, you enter your credit card information, and that's it. It's kind of all automated and integrated into one place. And what's really cool about that is QuickBooks does all of the record keeping for that transaction as the things happen. So when you create the invoice, it sets up the sale, and it sets up, it's called accounts receivable, that this person has been issued a bill. And then when the person pays you, it knows this payment is for this invoice. So it applies the payment to that invoice, records that in your bank account. It's kind of cool in the sense that in the old days, these would be very manual processes. Like, I can only imagine, when I started working, or in my parents' generation, you'd have a person literally, like, let's use that snowplow company as an example. You have a person sitting there either on a computer or maybe a typewriter before that, saying, okay, Mr. Tim, here is your snowplow contract. They would probably stick it into the mail, lick that envelope, send that envelope by mail 3 to 5 business days, or however long it takes to get to that person. That person would get it. They would write a check, send it back 3 to 5 business days to come back. And then the person would deposit the payment into the bank, and then they would, in their accounting records, they would have like a very manual process of recording the sale on this date, and then the payment, and matching up the payment to that customer over here. And it would be, a lot of work that technology in a way has streamlined and made very, very efficient, because now it's like snap of the fingers, it's all done. And all that time lag between sending it by mail and receiving the check by mail, the business days in between, is all gone. in a sense, because everything with the email could be instantaneous. Like I've seen a situation where the person can be on their phone creating the invoice, sending it by QuickBooks. The person is standing there with them on their phone. I got it, filling it out, I've paid it. And both people are kind of like standing with each other on their phones, and they can kind of take care of that transaction instantaneously, which is really, really cool. So for many people, this is kind of like the future, or this is kind of like a really nice to have. And similarly, like I mentioned earlier, the accounting software has capabilities for the receipts, the expenses as well. So I gave one example where you go, you take a picture of the receipt. The softwares that I mentioned have integration capabilities where the receipt goes into a portal or an app, goes into the system such that the receipt is now available with the accounting software transaction log. So if I ever have, let's say, a query about my meals and entertainment, I can go into it on my accounting software. I can drill down into the necessary details that I need, and then say on this date, what was the receipt, or what was the details about it, and that picture that I took will be there. Like magic, that I can go back months later, years later, and everything, if I've set it up properly, will be there, so I can go back and find it. So that is really, really cool. So the answer is no. So Nicole asked, do you still need to keep the original paper receipt if you're downloading it onto the software? The answer is no. If you have the full picture, if you have the full scan, depending on what you're doing, if you're scanning it or taking a picture of it, you don't need to keep the original. Oftentimes, you might appreciate this, paper and the stuff printed on it doesn't last 7 years. If you ever go to the gas station and you get that, I think it's called thermal paper that comes out of the machine, and it sits in your car for a couple weeks, or it sits in your jeans for a couple weeks, or wherever you like to put it for a couple weeks. If you take it out, a lot of times I find it's smudged, it's faded, it's just not very legible. So in a way, electronic record keeping is better because you don't have that quality issue. If you only had a paper copy of that receipt and it's smudged and faded and it wasn't legible anymore, I'm not saying that it would create a huge problem if you had a one-off like that, but if all your receipts turned out to be like that and you had a CRA issue, they would probably be a little bit concerned that, you don't have the proper documentation and paperwork to support your claims. But of course, that's another story for another day. So one thing I want to do, because I'm keeping an eye on the time, and I'm trying to be mindful of the balance of, I want to share information with you, but I think I want to show you something. And sometimes showing you something from a learning perspective is nice because it complements the practical, complements the theory. So I've shared some documents already with Heather and Marie Helen, and I believe they've been shared with you. So I'm just going to take a quick moment to show you something, and we can talk about it. We won't have enough time to probably go through all of it, but once again, it's not the problem or not the issue, because I want to get a little bit of a taste. Like you could say, like we'll get a sneak peek and a flavor of some of the bookkeeping in practice. Can you see my screen share? If anyone can give me a thumbs up.
Yes, I can see it.
Okay, excellent. So this is basically an exercise I put together where I wanted to do a very, very simple bookkeeping exercise to give people a flavor and a taste of, if you start a business, how can you keep your record keeping straight? Obviously there's some you need to start somewhere. So I said, okay, someone's starting a business, they have a month worth of transactions, and we're going to give people a little taste of what their bookkeeping looks like. And that way you can have, a little bit of a template of how to deal with this if this was you, or you kind of start a business and you need to start somewhere. So this exercise that I created, I made up all these numbers and all these facts. So if you see any resemblance to anything, it's just coincidence. And it basically goes like this. So I'm going to read from the top. On September 1st, 2018, Ron decides to start a marketing consulting business. He will be helping small businesses with everything marketing related. Ron has worked in the marketing and design agency for many years. So Ron has a marketing background, starts to offer marketing consulting. No different than if anyone has a background in something and they want to start a business in that thing. Consulting is kind of a very commonplace for people to start because you have some experience in the space that you're providing consulting in. So it could even be arts, it could even be construction, it could be food, it could be anything. There's consultants for everything that I've seen out there. So Ron's accountant tells him that he needs to open a separate business bank account, which he does. The following are Ron's business transactions for the first month of operations. Please help Ron with his bookkeeping. So in here, there's a little tip that I think is worth highlighting and mentioning. So if you start a business, it is wise, it's not mandatory, it's wise if you're going to be running a business where you are self-employed, you could choose to run that business through your personal bank account that you already have, or one of your personal bank accounts if you have many. That's fine. There's nothing wrong with that. There's no rule against it. However, in my experience, when it comes time to do the accounting, when it comes time to do the record keeping, it makes, whether it's you doing the record keeping, whether it's your accountant, whether it's your bookkeeper, it makes their life a little bit more complicated when they have to sift through a mix of personal and business transactions. It can be a bit of a pain, when you're going through the bank statement and you're like, oh, that was a lunch. But then it's like, that lunch was actually a lunch with my spouse. It's not related to my business. And then you're like, oh, the next day I had another lunch. Oh, but that lunch was with the client. That is for business. If you have everything kind of popping up on the same bank statement or credit card, then it can create this issue of personal and business and having to kind of separate the two with highlighters or other things. And I think that's a bit of a pain. If you can kind of segregate or segment or separate and either open up a brand new account, bank account, credit card for the business stuff, that's a highly advisable, highly recommended. Or what some people do is if they have multiple accounts, they say, okay, this account will be the business account and I'll stop using it for personal purposes because, some people have 3 accounts, 5 accounts, or 3 credit cards or whatever, and then they can kind of focus. So that's a tip that I have that should make your life easier when it comes time to do record keeping because it's only business related stuff on that card or bank statement. Now, down here is where the transactions start. So you can see from here to here, there's the month of September's bank activity. So like any bank statement, there's going to be some deposits, there's going to be some withdrawals, there's going to be a combination of, different types of purchases and things like that. So my goal is to kind of give you a little bit of a flavor. I'm not going to attempt to do the whole exercise in the time that we have, but I'll give you a little bit of a flavor maybe for the first, let's say, 3 transactions as a starting point to see how they look in the spreadsheet. And then I'll ask Heather and Mary Helen to share a solution file with you such that you can see the full solutions for all of this. If you do want to take a look at it or you do want to attempt to do the whole exercise, it is available to you at that point in time. So September 1st, the bank account is opened and 5,000 is deposited by Ron into the account. You open up a new bank account. It's very, very common that people will put some money in the account. It's kind of like maybe a preparation thing. Like you need money in the account because you're going to start to spend the money, which you'll see is the case. They spend money on the very next transaction. And also in case that, you have money in the account. So if something comes up, you're not out of money. Like I think in the old days, if you remember, you'd be worried, like, I don't have money in the account, and you write a check and then the check is going to bounce. It's not really a problem anymore, I think, because we don't write as many checks as we used to, and now we send e-transfers. But the sentiment is there that we want some money in the account so that we can deal with the stuff. So the very next transaction, so later that day, Ron purchases some business cards for $200 plus HST of 26. So HST is the harmonized sales tax. We in Ontario, where I live, it's 13%. I appreciate, if you're in different provinces, you have different types of sales tax. Like where I live in Ottawa, our next door neighbor is Quebec. Quebec has its own system that's completely different from our system. It's GST, QST, and of course, in the Yukon and other places, they're going to have different systems, but nevertheless, it's going to be a percentage. So that sales tax is going to apply. So in our example, whenever it says sales tax, I've given the amounts to avoid any confusion about having to use a rate or calculate it. The amount is just given. And then on September 3rd, so 2 days later, or 1 day later, I guess, depending on how you look at it, a computer is purchased for 1,000 plus HST of 130. So this person is making some purchases right after they put the money in the account. So it makes sense that they put 5,000 in the account because now they're getting their business up and running with these couple purchases they have. So I'm going to switch screens for a moment and show you my template. So this is the template that I created in Excel. It's very, I'd say reasonable to help with this type of question. It could be customized further. It could be further modified for different types of examples, for different types of situations. Excel has that flexibility. You can create templates. You can create different types of things that help with different situations. And then once you have a good template, you can hopefully use it. So in this case, if it's set up well, it could be used potentially to do the tracking for this business on an ongoing basis. I mentioned this earlier, worth repeating. We're using it specifically in the case of this business because it's a reasonably low volume business of activity. Like the month of September, maybe there was 12, 15 or so transactions. If this was a high volume business with, 50, 100 plus transactions, of course, that would probably not be a good idea to try to do in Excel. Now, a quick run through of how this template works. This column is specific to the date. If we ever want to look up a transaction, ever want to look something up on the bank statement, having the date just allows us to really quickly match something up here to the bank statement or to the records that we're trying to find. So the date is very, very important. This column, opening bank balance. So anytime you have a transaction, your bank balance will be modified after that transaction happens. Right now, we don't have anything in the account or on the spreadsheet, so it's 0. But after every transaction, we'll have a number in this column and we'll have a number in this column. Just like if you log into your online banking, my online banking anyways, after every transaction, it shows the balance in the account. So, if I paid my bank charges, here's the money in the account. If I sent an e-transfer, here's the money in the account. If I got paid, here's the money in the account. The reason for that is it allows us as the accountant or the bookkeeper or the owner to really, really quickly match our spreadsheet and the numbers information we have here in the bank balance to the bank statement or the online banking. We can very quickly say, this is the number I have on my spreadsheet. This is the number I have on my online banking or my bank statement. The two numbers match, or if they don't match, we can look into it. But it's a way to kind of look at that really, really quickly. Accountants call it reconciling. We can reconcile the two things. This block is for deposits. Obviously, we receive money. It's going to be a deposit. It's going to go into this section. And then this section is for withdrawals. So we spend money because in a bank account, either we're receiving money or we're spending money. There's only two real scenarios that can happen. If we spend money, it's going to go into one of these blocks, and we've set up a couple of the common terms, bank charges, legal and accounting, office expenses, to kind of cover off the typical types of withdrawals that we might have. So let's do the first three really quickly, and then I think we'll be at 9 o'clock and heading into the Q&A. So under the cash deposits, this one is specific to the owner putting their own money into the business. So it's called shareholder loan. So as the owner, we can loan money into the business. It's our money that we're putting in. It goes into that column. This column is if we sell something. If we sell something to a customer and it's income, it would go here. And if we collect HST on what we sell, we put that in this column. It's very, very important to put sales tax is to track sales tax separately, because when we charge sales tax, we want to make sure that we know what our sales tax obligation is. Sometimes, here's a quick tip, people will make a sale, they'll collect sales tax on that sale, they'll just lump it all together, put it in their bank account, which is fine, you're allowed to do that. But then at the end of the year, you sometimes lose sight of the fact that like you collected this much sales tax, you now have to send that money to the government. It can be a bit of a shock to some people if they had a really good year, collected a lot of sales tax. So having its own column allows the person to at any point in time see, oh, I've collected this much sales tax in the year. I should be ready, you know, when the time comes to have that money set aside or ready to send to the government. The first transaction was the $5,000 deposit into the account. And then you can see in this column, it pulled that number here. And then over here, starting from the second row, that number is there all the way down as well. So now my bank balance after that transaction is $5,000. The second transaction was the business card purchase. I'm going to call it an office expense of $200, and there was sales tax of $26. So I spent $226 in total. But once again, the HST or sales tax spent gets its own column, because the way sales tax works is the amount of sales tax you collect is one column or one bucket. The amount of sales tax you pay is another bucket. And when it comes time to paying or filing with the government, we look at the two buckets. How much did we collect? How much did we pay? And the net difference, which could be we collected more than we paid, we owe that money to the government. Or we collected less than what we paid, we can request a refund of sales tax from the government. So that's why there's two separate buckets, HST, sales tax collected and paid. And then the third transaction was the computer purchase for $1,000. With the sales tax of 130. So this is the first three transactions. I've obviously used this spreadsheet before, so I'm able to kind of plug things in, and you're watching me and you're like, oh, it's really fast. Of course, you would, you know, practice, build up your efficiency, build up your familiarity with the spreadsheet. And this could work really well for your business, because you can see down here, you get these really nice summarized totals of what happened in the month, right? You'd be able to see, oh, this is how much sales I had. This is how much HST I collected. This is my various expense categories. And you'd have a really nice summary that you'd be able to get. And let's say this is for 1 month, you do this for the whole year, you would then be able to see, oh, this is how my business did for the year, because that's the information you need to file your taxes. If you're self-employed, you basically need to be able to see how much revenue and expenses you had, calculate those amounts in summary to report that on your tax return. So in the year, this was my total sales. In the year, this was my total expenses. That basically is the basics of what the tax return is asking you to fill out. And then you pay tax on the net. Net meaning after expenses. So sometimes people have this question about, I started a business, it's not making any profit yet. You don't have to worry about paying taxes if you don't have a profit. You start to worry about taxes once you have a profit, which, you know, might be some time before you get to that point in time. because your business needs to grow and build and all that stuff. So before I wrap up, I just think it's worth showing. I'm going to show this one. So this is the solution file that you'll get from Heather and Mary Helen. And this is the one that's completely filled out. So you can see the first 3 transactions are the ones I did with you. And then the remaining transactions that I did not do with you, but you'll get them, and you can certainly work through them yourself if you'd like, are all here. And then there's this really nice summary of, in the month, as an example, my total income from sales was $1,300. My total HST collected was $169. My total bank charges was $6.50, and so on, right? And I can do a really, really nice summary of any and every expense and income category I might have so that I can be well prepared for my tax time, that I can have all this information ready. So Excel can work really well in the right circumstances, and many people have it. So I'm encouraging or suggesting that it's worth considering if Excel will solve the needs that you might have for your business. It's not a one size fits all. You might have to see if your business has the right level of volume, or do you like doing this manual data entry, or if you have too much volume, or you like the idea of integration between your accounting software and your online banking, or you like the idea of being able to issue invoices with the accounting software with integrated credit card payment processing. Like, those types of functionality aren't going to exist here, right? So I'm not going to be able to send someone an invoice and get them to pay me with a credit card using Excel like I would with QuickBooks. So of course, those pros and cons would have to be compared. Same thing with the receipts. If I want to take a picture of a receipt, if I have an accounting software with that capability, it'll save that receipt and have it available for me at a later date. Excel doesn't really have that capability, and that would then need to be like a separate system altogether if I wanted to do that. So the question, the template, the solution file, you'll have all of them. I think you have 2 of the 3 already, and then you'll be able to kind of, sink your teeth into this further if you'd like, and use it for practice, use it for yourself, as well as look into those accounting softwares and look into those things that I mentioned earlier. So I'm going to start to slow down and pause. And I think it's a little after 9. I think we can get the Q&A going by all means so that we have the time allotted for it. So I'll start with the chat, but by all means, if people want to add more to the chat, if people want to send questions that way, I think Heather or Mary Helen mentioned, if you do want to use like your microphone to chat and ask a question, you will be in the recording, so you have to just be okay with that. Otherwise, the chat's better. But that is another way we can take questions if someone wants to ask a question that way, because sometimes you can't type what you're trying to say, so you might want to say it. But let me start. So what is the meaning of H in sales tax? So H stands for harmonized sales tax. So harmonized in Ontario means that the federal and the provincial governments have combined their sales tax into one rate. So you get this one harmonized combo tax of 13%, whereas in BC, they have the federal GST tax and the provincial PST tax as 2 separate taxes. And I think BC is actually a province where they tried to harmonize and then they reversed it because it wasn't well received. People didn't like it being harmonized. Ontario actually used to be separate, and then maybe, I'm going to say like 8 years ago, roughly, went to a harmonized system, and it's been harmonized since. So some provinces have a 2-in-1 provincial and federal sales tax system, like Ontario. And some provinces like Quebec, like BC, have a 2-tier, like 2 separate taxes, so they'll have provincial and federal. The one after that, harmonized sales tax in Ontario, is GST and provincial. Oh, I think Gloria answered my question in the chat, so thank you. Someone asked about how many years you can operate at a loss. So there's no limit as to how many years you can operate at a loss in terms of like a hard and fast rule. But the government does want you to have a business that has the intention and expectation of turning a profit. Because if someone starts a business and it operates at a loss and they never pay tax, the government can understand that for a period of time because the business needs to get up and running. But I've seen people get questionnaires after a couple of years, let's say 3, 4 years, where if your business is operating at a loss on an ongoing basis, sometimes the government might take the position that this isn't actually a business that's designed to make money. This is more of a hobby. And in that case, a hobby isn't a business. We wouldn't be able to claim that loss on our tax return. Because if you do have a loss from your business, and let's say you have other sources of income, let's say you have a job and you make some employment income, and then you have a business and you lose money, from a tax perspective, the loss from the business will help reduce your overall tax burden so that you'll be paying a bit less tax on your employment income because you have this loss. So if you have this ongoing for, let's say, 3, 4, 5 years, the government may at some point in time say, hold on a second, this loss is helping you from a tax perspective, but is this valid from a business that's going to eventually and has an expectation to turn a profit? That's one of the definitions or requirements of having a business, is that you're doing it with the full intention of making a profit. You don't have to make a profit, but if you never make a profit and a number of years go by, they will likely ask about it. Someone is asking about the templates, so I'm sure that Heather and Mary Helen will send that along. If you've missed something, if you sell something, is it mandatory to charge the applicable sales tax? Okay, so this is a good question. It's a bit of a deep answer, but I'll try to keep it reasonably light, but informative nonetheless. So if you start a business, you don't have to register for sales tax. The requirement to start to register for sales tax is $30,000 of sales. So what I tell people is, if you're starting a business, you have a choice. You could register for sales tax from day one just to avoid this transition. Because think of like this example. You start a business, you don't charge sales tax, and you're kind of running your business. People pay you the amount that you charge, no sales tax on top. Great. And then after a year, after 6 months, after 2 years, whenever that point in time is, the threshold is $30,000 in a 1 year period. If your business exceeds that threshold, you now have to register for sales tax. And now all of a sudden you start to charge your customers sales tax. Some of those customers might say, oh, your prices just went up, like by a lot. You know, in Ontario, it's 13%. 13% is not a small amount of money for a price to go up by. So some people might think of that and say, I don't want that whole ordeal of not charging sales tax and then my customers getting used to it and then charging down the road. You can optionally register for sales tax from the day you start your business or at any point in time. If you do, you charge sales tax from that point in time. However, you're not mandatorily required to charge sales tax until you reach $30,000 of sales in a 1 year period. So there's one scenario that I think, if someone is going to operate a business that will always, as far as they know, be under $30,000 of sales, like it's a hobby, I shouldn't use the word hobby, but it's a small side business, maybe in addition to their employment or other stuff they do, they could be well served by not registering for sales tax because they will be under the threshold. They don't have to worry about it. They won't have a situation where they register and their customers now are like, oh, the prices went up. That works really well. But I think for other people, if you're starting a business and your business is either going to be 30,000 in a reasonably short period of time, or you're going to be growing this business and that's becoming like a focus for you, and you're going to be working on this business, then I think registering for sales tax and not having that other issue I mentioned just makes sense to be kind of on that path. But to answer the question, if you're not registered for sales tax, you don't charge it. If you are registered for sales tax, you do charge it.
Sarwar, earlier somebody was asking how safe those softwares were if people are a victim of identity theft or some other cyber crimes, like what happens?
So I think like I don't want to speak to that because I think each of those websites will have information about their security policies, about their it's like a bank, right? Every bank will have a section about what happens if, you know, like if your credit card is compromised, if your bank account or banking information is compromised. So I don't want to speak to it. I would answer that by saying in their websites, they'll have information about their security features, about their policy. As far as I know, they're all going to do a really, really good job of protecting your data, of backing up information. It's like if anyone uses Google Drive, you know, my expectation is Google is going to do everything they can. Dropbox is another one. Like once you put something on there, it's they're gonna have backups and backups of backups and all that stuff because that's a service you've purchased and you have an expectation that it will always be available. I'm not saying nothing could disastrous could happen, but that's my expectation with these big companies is that they will do a good job of holding up their end of the bargain. But you can read about their policies and not take my word for it because I don't work for any of them. I'm gonna scroll down. I'm at Omar's question. So Omar's asking about the threshold for sales tax, which I think I answered in the previous question a little bit. So I think that might be good for that. And you have a joint bank account. So you don't have to open a separate bank account, but if there's transactions going through that bank account that are not related to your business, and then you start running your business through that bank account, it will just make your record keeping a little bit more complex. So we recommend having a bank account only for the business if possible. It just makes the record keeping simple or simpler, I should say, but it's not mandatory. It's just recommended. Someone is asking for the recording. Yeah, so someone is asking about mileage. So there is a mileage rate that the government has, and the mileage rate works well for these short trip or short um, low number of kilometers per year. So I don't know the mileage rate in Yukon, but I'm just gonna like make up a number as an example. So let's say the rate is 70 cents a kilometer, and that might be the rate. I think in Ontario it's 68 cents, if I'm not mistaken. So you can use that rate, you can look it up online. And then if you're only doing a couple of small trips and a couple of short things, that rate works well because then you're only looking at the business trips, the 3, 4 trips, or however many number of trips you did, the kilometers you drove for business, multiplying it by the rate and getting the number that way. That works well for those scenarios. If you're using your car regularly for work, the more common method is you track all of your gas receipts, all of your insurance, all of your maintenance, all of your total expenses. You track all of your mileage, business and personal, and then you get a ratio. So let's say your business mileage, personal mileage works out to 75/25. 75% business mileage will then get multiplied across all of your gas, insurance, all those expenses, and that will be how your deduction is claimed on the tax return. So that's the more widely held methodology if you're using your car and vehicle regularly. If you're just doing a couple small trips, then that other methodology does work well. Like I think the person said 5 or 6 trips. Someone is asking about the craft shows and they don't happen very often and it's a lot of deposits. So I think Excel could work well because even if you have a lot of deposits, you can probably aggregate them together and add them up. So, you know, if you have like 5 or 6 or 7 deposits, but they're all happening on the same day, going through either a payment processing system or e-transfer or whatever. You could add them up and aggregate them into the Excel to make it kind of simpler that on, September 18th, these are all the total deposits I received, and you don't have to worry about separating them out in as much detail. I think it can work well. The other thing that I think is worth mentioning is you have to be comfortable using Excel, right? Like I used Excel, I use it all the time. For me, it's comfortable. For some people, if you don't have experience with it, it might be a little bit of a learning curve. And then adding on top of that, the bookkeeping stress, then it might not be the best solution. But if Excel feels comfortable, I think it can work really well. And then if I do use Excel, what would it look like? It could look something like the example we did. I mean, it's not the same business because we're talking about a consultant and a craft show, art business, but generally all your deposits would have its column, all of your purchases and expenses would have their respective columns. It could look very similar to the spreadsheet that we had. Like the template I sent, you could maybe even customize it, tweak some of the headings, add some other columns or add some other headings to make it kind of fit, because you might want to, like, you might not have a lot of something but have a lot of something else. You might want to change one of the categories or add another row. You can do all of that in Excel fairly easily. Do you have to contribute to CCP from your business? So if you meant CPP, because that's maybe what I'm thinking you meant, the answer is yes. So if you are self-employed and you are filing your personal tax return with your business activity, CPP, which is Canada Pension Plan, is part of the calculation on your tax return on the business income that you're reporting. It's mandatory. You can't opt out of it. If the business provides a good, meaning using inputs to get an output, where do you add materials to the spreadsheet? So that's what I was talking about a moment ago. If you have materials that you're buying and then selling, you could change one of the categories. Like let's say the legal and professional, you could take that category out, put in materials or purchases or something else in its place, or you could add another column altogether to capture those expenses. Because the one I set up in that consulting business, there wasn't any material purchases. So I don't have that category in my spreadsheet. It's not to say you couldn't easily add it in or create it in yours if you wanted to. So someone is asking about the level of detail for their income. Generally, there's like anytime you sell something, you should have an invoice, or you should have a sales agreement or a contract or something that stipulates what it is you're selling, whether it's a service, whether it's a product, whether it's art. If you have that invoice or that contract, that level of detail, you then don't need to get into all the detail on the spreadsheet. You could just do the summarized total. Like let's say I have an invoice and I'm selling 8 different things, and then I have a subtotal and the person is paying me the total. In my Excel spreadsheet, I'm just going to put the total deposit amount. I'm not going to worry about all the 8 different things that I sold, because I have an invoice or a sales contract or something else that stipulates here's everything that I sold. The grand total of what I sold is, let's say, $2,000. And I'm just going to put the $2,000 into the spreadsheet. So I'm only going to be worried about the totals on the spreadsheet, but then I'm also going to be hopefully having some invoices and supporting documents to support all the detailed amounts that are part of the breakdown of that total. And then art market, same thing. I would imagine if you're selling something, you're offering your customers receipts, whether it's like, I remember in the old days, it's still probably possible, you could get like this book, and then in the book, it was like customer receipts. And then, you could like quickly write out name and date and all the stuff, and then like rip it and give it to the person. And then you would keep a copy, because it would be like that paper that's, I forget the name, but transparent, or that's not the right word, but it would be that paper that like makes 2 or 3 copies in the in the writing of it. So you would give one away, keep one. So whatever it is that you're doing for record keeping, whether it's giving those receipts, whether it's sending an invoice or using a software, as long as you have that, then you're fine. So apps for receipts, there's one called HubDoc. That's a good one. That's a fairly popular one. And that's a good app for receipts. I would say if you look into the accounting softwares I mentioned, it's kind of interesting. Each accounting software will have its own suite of products that it works with. So it's kind of like its own island of ecosystem of stuff. So if you go into the QuickBooks world, it will have its payment processing of choice, its receipt application of choice, and so on. And if you go into FreshBooks or Wave, it will have its own as well. So if you find one you like, then you can kind of go into their ecosystem because then everything will be integrated. That's probably the best way to approach it. But if you just want a receipt app on its own, HubDoc is probably a good one. And I'm pretty sure it syncs with one of the softwares that I mentioned. And are you okay with using a template? Yes, the template is for your benefit. I purchase products with my art printed on them. Some items I sell, some I gift to family or friends. How would you recommend accounting for this in the bookkeeping? So I would recommend creating a column for purchases, and every time you purchase something, have it recorded in that column on the withdrawal expense side. And then, of course, if you sell something, it'd be part of your income. And if you give something away, it just won't show up as income, but you'll still obviously have the expense, the purchase that you paid for it set up. There's a question about sales tax. It's 30,000. I think the question says 3,000, but it's 30,000. So I think 1 0 missing. And that's sales, not profit. So 30,000 of sales is the threshold that you need to register for sales tax, not profit. You could have no profit and still be required to register. CPP. So if you sell stuff at an art show, you don't need receipts for every single transaction. So you, as a seller of something, should offer receipts. I realize not every customer will ask you for a receipt. Some of them will just pay you and walk away or whatever, and that's fine. Just like in my example earlier with the restaurant, there was an option for no receipt. So by all means, if they don't want one, you don't have to give them one. But you should, if you're selling something, the best practice is you should offer one. So you should say, would you like a receipt? You should keep track of a receipt. You should be able to offer one. So if you have a system like QuickBooks or Square or any of those, depending on what you're doing for payment processing or how you're accepting payments, you should offer one. Whether or not the customer takes it, that's their choice. But the onus is on the business owner to offer. Carbon paper, yes, that's the one that has the multiple copies. The shareholder loan, yes, that's exactly how it works. You are lending your business money to help get it started, or even at any point down the road, because people could lend money to their business on an ongoing basis, so they can then withdraw that money, pay themselves back. It's kind of like getting a loan from a bank, but you obviously, in this case, are the financier or the bank. Funding from arts grants. So that's an interesting one. So when I did the presentation for CARFAC, this was a pretty detailed section. And the short answer, because that's all we have time for at this point, is check the agreement. Most grants are taxable. So what that means is if you're getting a grant, it's like you received income. So you report the revenue under that column for income, you pay tax on it. Most grants, you don't have to charge sales tax on though. So it's basically income without sales tax being charged on it, but it is income. You can occasionally have a grant that's not income, but it would be very, very clear in the agreement. Because if you, let's say, take the position that you got a grant and it's not taxable when it is, obviously that would create a problem for you. So you want to make sure if it's not taxable that it's clearly documented and then you take that position. But the majority of grants that I've seen are taxable and would be reported as revenue. HubDoc. Oh, someone answered that already. Oh, I made it to the bottom. So I think I made it to the bottom just in time because my clock is at 28. But by all means, I'm happy to turn it back over to Heather or Marie Helen, or if there is another question that we can squeeze in there, I'm happy to do that. But we are basically right on time.